Hello, welcome to the Economic View. I'm joined as always by Evan Lucas, our Chief Strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, let's talk about some of the data that's come out this week. There's been some interesting stuff. So the manufacturing data, let's talk about that. Let's talk about retail sales. And lastly, not leastly, but lastly, we'll talk about what happened with the Reserve Bank this week.
Yep. So even though we've got a shortened week, there's been a lot that's actually come out. So let's look at your first part of your question, which was the manufacturing PMI. Something we normally never talk about because manufacturing in this country isn't large. It is fairly small, but it is there. So the chart on screen, I know it's a little bit messy, but it does show you, this is the PMI data, so from the AI group, PMI data and the ABS. So this is the two data to put together. Actually shows some really interesting thing. For the last 18 months, we've been expanding in manufacturing. So that means that the index is above 50% or it's above zero for the ABS, which is what you can see on that chart. Not only that, we just registered a record print of 63.1 on the PMI. Last time, the highest it's ever been was 62.1. So it's a 1 point beat on May 2002. So you've got to go back a heck of a long way to beat that. We are expanding pretty much across the board in the subsectors. So that's things like new orders, exports, production, sales, etc. If you want to actually go into the sectors, there's only one sector that's contracting, and that's in things like clothing and textiles. Everything else is expanding and expanding quite neatly. It's not like it's at 50.1 or 51. It's rapidly expanding. So who knew? Manufacturing in this country is actually quite strong, and the data on the ABS side is backing that. It's also been shown to some extent in the GDP figures. So it's a real positive that come out this week, and that's why I thought that chart's quite a good
so
thing.
what's actually driving all that growth in manufacturing?
So there's, again, looking at what the reports are saying in terms of where it is at, it's several things. It is actually demand for product, and that's a good thing. We know that consumption has been up, not just here in Australia, but globally, because a lot of this stuff, again, you've got to look at it from the point of view that a lot of it's exported. So we know that net exports over the last 18 months has been really positive. It's part of the reason why our GDP is good, so that feeds into it. The quality of the product is also improving, and therefore demand for it's up there as well. So all of that's what they allude to about manufacturing. Again, I would put a caveat there. Manufacturing is no longer the size.
It's not the mainstay.
It's not the mainstay of what it once upon a time was, but it is positive data. And before I go to the rest of your questions, do want to sort of point out, I know the first quarter of 2018 was really volatile. It's the worst start to the year we've had since 2016. It's actually one of the worst quarters we've had in the post-GFC world. We've only ever had 3 negative quarters, and that was one of them. But if you look through it and look at the macro data, what we love to talk about, there wasn't actually a huge shift away from what we're forecasting for 2018. And I think that needs to be your base case for this quarter, is that GDP globally is expanding. In fact, it was upgraded. Inflation is there, but not at a huge level, but it is materializing. Employment is strong, but underemployment is still a headwind. So that's the other thing. So getting next to your next question about what else has come out this week, retail sales are out. They're up by 0.6.
They're up.
And they beat expectations. Everything, again, in that space is pretty positive. All the subsectors actually expanded. Department stores had its best month in 3 months, so it broke out of a negative cycle to be positive. So there are good signs coming out of that as well. I think your last part of your question was looking at also the RBA, and let's talk about that. We'll brush over what we knew. Didn't move rates, not expect to move rates for the next 12 months. Interbank market has dropped below 50% chance of now a rate hike in the next 12 months, so that's all there. What we have been talking about, though, in the last 2 to 3 weeks particularly was what's going on in the credit market. And I know we've been talking to people about what could happen to home loans, etc. And the RBA actually highlighted that in their statement yesterday. I think it's a good thing to be aware of, that the RBA is very much keeping an eye on the fact that the LIBOR, so the London Interbank overnight rate, is expanding globally, and we're feeling the effects of that. And we've talked about the bank bill swap rate jumping through 2%. Does create higher lending. It therefore means that there's just higher charges, and they do realise that could crimp things like their GDP forecasts, things like their employment and their inflation forecasts. And I think that was the most interesting thing out of it, is that they are fully aware that there may just be natural tightening from the market coming in. Although they don't want to move rates, it probably actually slightly helps them around their macroprudential rules to slow things down again. And what also came out this week was housing data from CoreLogic, and it showed again that as a nation we've slowed down further. It's the fourth month in a row. Sydney's probably a major driver of that. Melbourne's still going quite strongly, but in the main, housing market is also coming off, which is a whole heap of factors, but clearly macroprudential rules and some slowing of lending.
Yeah, so we've got some very positive factors in the economy at the moment, especially with manufacturing, retail sales. Rates, as we've just said, aren't likely to move soon on the Reserve Bank level. We'll have to wait and see what the banks do in there. But so from an investor point of view, I mean, on the one hand, this is saying that things are looking, quite rosy economically.
Yep.
We've got all these growth factors in the economy. Then underlying that, I suppose, is what happens with rates down the track,
Yep.
and that's obviously going to have flow-ons into other sectors, including the property market.
Yeah, and the way I'd probably point to that is have a look at, for instance, with what is being currently looked at in that space is that the sectors and areas that are performing the best at the moment are those that have got income but are actually got a growth profile. So those, there are a lot of funds out there, including ours, that sort of are looking towards being not as heavily weighted towards banks, particularly because they've obviously got capping issues and lending issues, but do have exposure to growth. And that is things like building and construction, that is things like mining and materials, that's things like energy. But these are also companies, particularly in the Australian market, that still also pay you. So getting from where I come from, sitting from a strategy perspective and feeding in that global growth story, feeding in a slightly lower inflation story, growth is still the key. And that hasn't changed. And that's why I said in there that you need to continue to look at the fact that the data we got in the first quarter is still very much on track for what was forecasted at the end of 2017. 2018 has been, as I said, a bit of a nervy start, but Q2 still looks quite good. China tends to come back online as well. China tends to have a lull after Chinese Lunar New Year and then picks up gradually through Q2. So all that feeds into it. So again, from that question, from an investment point of view, you can still see staying the course for peaking in growth in GDP is going to be what's likely to happen, and therefore it's those stocks that have a growth profile that are probably likely to continue to outperform. There will be shocks. We know about the volatility, and I've spoken about what geopolitics is doing at the moment. But in the main, if you want to look at it, it still sits about that space.
We'll leave it there today. Thanks, Evan.
Thanks, Tony.
Thanks for joining us on The Economic View.